If you're buying a primary home, vacation home, or investment property, financing can be a key part of making it all work. And while you might have the money saved up, pulling from your retirement accounts can sometimes potentially lead to unnecessary taxes. On today's show, I have guest Michael Bischof, Regional Vice President of Mortgage Lending for Guaranteed Rate, and he's going to talk to us all about financing your next home purchase. He's going to provide us tips on how to finance that home purchase without it being contingent on the sale of your current home where all of your equity might lie, how to compete with those all-cash offers, alternative financing tips for buying a vacation home, and stick around to the end where we talk about why buying a home and qualifying for a mortgage in retirement is a lot more challenging than pre-retirement and how to overcome some of the obstacles that you might face.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of the Retirement Show, all about your life, your money, and your taxes. We're here to talk about thoughts, strategies, and actions to help you thrive in wealth and retirement. I'm your host, Scott Searens. And today I have a very special guest with me, Mike Bischof, who is the Regional Vice President of Lending for Guaranteed Rate. So whether you're buying a primary home, your vacation home, or an investment property, financing can be a really key part of making it all work. And that's why we have Mike on the show here today. A little bit about Mike before we get started. Born and raised in the Chicago suburbs, and in 1996, he founded Bitmore Financial Bank Corp., a mortgage banking firm, which then he sold to Guaranteed Rate in 2011. Since he's been the regional vice president of Guaranteed Rate, one of the nation's top 3 largest retail mortgage lenders. And him and his wife have 3 children. Mike, welcome to the show, and thanks for joining me.
Thanks, Scott. I appreciate being here.
I mean, over 31 years of experience in the business. You've been doing this a long time. A lot of people have bounced, from career to career every 5 years or 7 years or 10 years. What got you into the industry and what's kept you here so long?
Yeah, it's kind of things turn out. I got in the business when I was 24, and I had a friend that started out as a loan processor for a mortgage company. I was working in corporate America the first 2 years, and just really saw the way in which you could kind of control your own destiny. You could build a book of business. You could really help people with really what's thought to be one's largest purchase that they'll have in their lifetime. So it's been very rewarding in acting in a financial advisor capacity with my clients to, offer a best strategy, a best approach to getting a mortgage.
Yes, and I mean, we've worked together with some clients before, and I like how you kind of talk about it on your website too. You talk about liability management. Sometimes people look at this and go, "Oh, I've got to go out and get a mortgage so I can afford this home." But you're really helping people with that. I mean, assets minus liabilities, that's our net worth. You're really helping people manage that liability portion of their balance sheet. And it's more than just a mortgage, because as we'll talk today, I'm certain there's a lot of different ways just to manage that liability section.
Correct. Yeah. The mortgage is oftentimes thought of, I think, as having a simplistic need and having a simplistic solution to that need. And when it couldn't be more from the truth, done effectively, it's important to recognize how the mortgage should coexist amid the rest of one's financial picture, taking into consideration assets, liabilities, that there's implications that one thing has on another. And so taking a complex total view of one's balance sheet can really help to promote and put together the best strategy for our client.
Yeah, and I've seen this, and especially in today's real estate market, and we'll talk about this in the show, is that you're not always able to sell your home first prior to buying the next home. So I'll just kind of leave that little teaser out there for people, because we'll talk about that today. But somebody's listening to the show today, they're out there, they're looking to buy a home, whether it's their primary home, a vacation home, or investment property. Some might not have the cash just to be able to go and make that purchase outright, but some might, and they might but they might have it in a brokerage account or a retirement savings account like their IRA and 401k. And we talk about taxes all of the time on the show and helping people manage their tax liability. And sometimes it doesn't make sense for them to just go take this huge lump sum out of that account because it could push them up into a whole nother tax bracket. Or, it could really mess with their taxes, and taking that lump sum out from a retirement savings account doesn't always make sense. So let's just say someone's decided to buy a home, they need financing. I am by no means an expert in your field. And I find a lot of times too, whether somebody has a little assets or somebody has a lot of assets, it can be confusing on whom to go and speak with or talk to. And do you mind just kind of starting with what's the difference between a mortgage broker, mortgage banker, and just in your experience, whom should somebody be reaching out to?
Sure. Okay. A mortgage broker is thought to be a representative who can go out to the marketplace and have what we call a multi-platform, where they can research and obtain product and pricing from a number of different investors. A mortgage broker has less control than that of a mortgage banker. A mortgage banker, such as Guaranteed Rate, we are a mortgage banker in which we too go out to the marketplace and have many sources of funding. If you think about it, if somebody went to local bank A, that's not a mortgage banker or broker, a bank, just a regular banking institution, oftentimes has one source of lending, their own. Whereas a mortgage broker or banker has several sources of lending. So if you put bank A in your left hand and compare that to multi sources of funding in your right hand, while not always the case, the odds would probably lie in favor of the multi-platform having both more competitive interest rates, but also a wider, more varied set of guidelines. Because with a bank, there's one single source of funding, but also a source of guidelines, and it's either it fits the box or it doesn't. So with a mortgage banker or broker that has multi-sources, guidelines can vary from investor to investor.
So by looking at if I'm understanding it correctly, looking at or utilizing like a mortgage banker or broker, you're basically opening up your options. While you might be working with one person, that person has then opened up options for you for sources of funding, potentially better rates, et cetera.
Better rates, varying guidelines, things like that. Correct. Yeah.
Okay. And as somebody gets started out, what are the questions, if they're reaching out to somebody, what's the questions that they should be asking to just even make sure they're finding that right fit?
Sure. So a mortgage banker takes on more control of the loan than that of a mortgage broker. So one question I would have if I was going out to the marketplace as a consumer looking for a mortgage is, what things do you handle versus what things do you outsource to others? In the example of a mortgage banker, i.e. a guaranteed rate type of institution, we control the processing, we have in-house underwriting, we have in-house closing, we fund the loan, and then in many cases, we even service the loan. People may very well be making payments to us as their loan servicer. A mortgage broker has less control. They don't have the same in-house familiarity that we have with, and anybody like me, I'm not selling Guaranteed Rate here, but anybody like us where we have more control, they have less control. And with less control can mean, more issues that may rise.
Okay. And so having that control, and we'll probably get through this, as we talk more today, but as we learned, the audience, I'm saying a couple of weeks ago, we had a realtor on the podcast. And as we learned, it was all about getting things across the closing table and having the right partners to getting things across the closing table. So it sounds like having that control can be helpful to make sure that as you're buying this home, the home that you've chosen, the home that's really special to you, having that control is going to help somebody get across the closing table.
Less people, I think, less hands in the fire, more familiar hands in the fire lead to generally a smoother, more pleasant process.
Great. Awesome. And, the other thing that we learned when interviewing the realtor is that in that buying process, part of her process was, if somebody reaches out to her and says, hey, I'm looking to buy a home, first thing she's going to say is, have you sat down with your mortgage person yet? Have you gotten either pre-approved, and maybe you can explain the different language there, but at what point in the process, because I know sometimes if people are like, okay, I want to buy a home, and sometimes unfortunately the dollars of how to get it done don't come right. It's not our initial thought. It's just like, hey, we want to buy a home. But I think it's pretty early on. At what point in the process do you think is kind of best for people to start reaching out?
Knowledge is power. And in today's environment with lending, is very well a good chance that someone who reaches out to a referred lender is not going to physically meet with them necessarily. It might be on the phone. So to me, when you're talking about, one of the biggest purchases, one of the biggest investments you're going to make in your life, I urge people to get out in front of it and really many months in advance of actually wanting to go through and find a place, have that phone call. A lot can be accomplished within a 15 to 30-minute phone call, from the convenience of someone's home to that of some advisor's office. Just like in your business, your planning is paramount to success. I think the same thing holds true for mortgages, and for reasons people, again, I think they look at mortgages. They're taught that the first thing you should ask is, what are your rates? They're taught that mortgages are a commodity, but really there's so much that can go into preparing the best foot forward with financing to save yourself the most amount of money. That just get out in front of it and start well in advance. There's things that people will do, common sense and lending sense aren't always congruent with each other. And so people through common sense may have certain actions that they have demonstrated in the months leading up to buying a home. Sometimes those actions are good, sometimes they're bad. So we talk in terms of revocable versus irrevocable actions. And we just don't want you to get too far down the rabbit trail leading up to buying a home where you're doing things that you think are good to help your situation, when in fact you're only hurting your situation.
Yeah, that's a great point. And one thing I want to add on top of that is I think it helps set expectations of what a person can afford as well. Because otherwise, if you start looking at that wrong price range, right, as far as what you can afford, and then you sit down with Mike or somebody in your position, then all of a sudden you're like, oh, hey, based on the overall financials, here's what we can actually afford. So I like it that people sit down really early on with yourself. I mean, even before they even go out and look at the first place, it's like, hey, and you've taught me this, is that, hey, if it's on your mind and you're thinking about it, like you said, spend that 15, 30 minutes, just have that conversation and grab that knowledge around what you might be able to afford, around different ways that you might be able to make it happen. And I like what you said there. A lot of times we can get inundated because we start searching, right? And then it's like these Google things just kind of start tracking us around and telling us, oh, the lowest rates are here, the lowest rates are here. So there's rates advertised all over the place. And you started talking about rates are one thing, but what is it that a person should really be focused on when it comes to, I guess, yes, the rate, but also who they're partnering with?
Sure. Well, I think, again, I would ask the question of who underwrites the file. Is it local in-house to somebody that's an employee of the same firm that the lender's working for, or is it outsourced? I would ask a lender, what are you selling? In this, what I've seen with the younger kids coming into the business that are in their mid 20s to early 30s or mid 30s is they only really know how to sell rate. In my situation, 30 years of doing this, I'd like to think that I sell advice primarily and rate secondarily. Not that there's anything to hide with rates, because I'll put our rates up against anyone, but really it's so critical to focus on the advice. So I think finding out the number of years someone's been in the business. Are they a multi-platform lender? Meaning they can go out and find several sources of funds from different lending institutions. And then what is their use of technology, which can vary considerably from one firm to another. So technology helps to make things easier. And to the extent that the consumer wants to embrace that use of technology, can really make for an experience getting a mortgage that's different than what their parents experienced, because technology really helped us to truncate some of the processes that would otherwise, and documentation that would otherwise be needed to get a loan.
Wow, some really great questions. And I think a lot of times people are, I don't want to say scared, but maybe it's just a fear to ask those questions. And here's Mike right now telling us, right, here's the questions to ask. Here's what to focus on. Here's what to look for. And Mike, if it's okay, I'll have you send those over to me because I'd love to put them in the show notes. And that way people are really comfortable with what they should be looking for and focused on. And so for anybody listening, you can go to lifemoneyshow.com. Again, that's lifemoneyshow.com. You can look in the show notes. We're going to have notes and links for everything that we discuss here on the show. All right. So moving forward, we've figured out what to ask. We know who we're looking for, and we're out to buy a home in today's still competitive market from what I'm hearing out there. And I'm guessing you're seeing as well, sometimes multiple offers, maybe not 15 offers like it was been in the past, but it could still potentially be multiple offers. You know, I hear realtors saying, if you're going to buy a home, don't make any contingencies on your current home. And while people have a lot of equity built up in their current home, that's what they plan to use for their next purchase. And so maybe I'll just kind of throw out an example here, but maybe it can help us understand, how do you buy a home in today's competitive market when you need financing? So if somebody's, buying a home for $500,000, but $350,000 of equity is locked up in their current home, but they don't want to put that as a contingency, how do we go about this, Mike? What's the process?
So there's three things that a lender will look at to see if someone can qualify for a purchase not contingent on the sale of one's home. In no particular order, just as I think of them, it's can the borrower absorb both the debt on the current home, principal, interest, taxes, and insurance, as well as the principal, interest, taxes, and insurance on the new home, as well as any other debt they may have, car loans, car leases, student loans, things like that. So all this debt combined, when you're buying a home, even if you're going to list your home right away, the lender will assume that you can't sell that and that you're going to be stuck with that property for a while. So they look at both the current debt plus the new debt plus other debt and make sure that your debt to income ratios can absorb the payments from all those. That's the first thing. The second thing is reserves. Because you're carrying two properties, a lender will say, we want to see that this person has more money to fall back on should they get in a tight situation financially. And for many people, most people that have 401ks or IRAs, those can act as reserves. We're not asking you to put that money anywhere. It can be kept where it's presently positioned, but just rather we just need to verify that there's money that you have to fall back on to be able to support one or both mortgages if you got in that situation. And then lastly, the asset that part, as you talked about, it's a big thing, Scott, with assets is I've got all this equity trapped in my current home. I don't want to sell assets, or what actual clients might come to you to say is, I need to free up $250,000 for a purchase because I don't have my home sold. And you may say to them, well, that's great, you have it, but the tax implications of selling the $250,000 in assets, you might have to sell 300 to net 250 because you'll have a $50,000 tax bill. So no one wants that to happen. While this may feel or seem counterintuitive, especially for the seasoned homeowner who's had a mortgage for a while and who's accumulated a bunch of equity, they can do one of a couple things. They can put down a minimal amount of a down payment. There's nothing wrong with putting 5, 10, 15, or 20% down. On a $500,000 purchase price, 5% down is $25,000. So they're starting out alone in this example that they're leveraging themselves to 95% of the purchase price. Now, when they sell that home and they've got this equity, they can take that lump sum and apply it towards the balance. Now, without asking or doing anything other than just a typical prepayment, I'm sure a lot of the listeners have perhaps prepaid, some amount of dollars on their mortgage each month. When you prepay, it naturally will go directly towards the principal. It will cut down on future interest costs because you have a lower balance, and it'll shorten the life of your loan. But what it doesn't do, it doesn't change the payment. So the natural reaction I might get from a seasoned, homeowner is, well, that all sounds great, Mike, but I really don't want a mortgage payment that's based on a 450 loan. When in fact, hopefully a few months from now, I have a 150 loan because I've plopped down, 250 or $300,000 towards the balance. We get that. We understand that. So what's also very important for situations like this is that the consumer asks the lender whether there is what's called a principal recast option, or some lenders will call it a principal reamortization. And that is the ability to not just take a lump sum and plunk it down against the balance, but in conjunction with that, when paying that lump sum down against the balance, to have your payment recalculated to be more reflective of the remaining balance on the loan. So that person pays the loan from 450 down to 200,000 with that $250,000 that they received in equity from the sale of their home. Now you want payments to be based on $200,000 at the same interest rate. It's not a refinance, so don't get confused. This is what's called a recast. You keep the terms of your loan intact. It's not a refinance. It's that you pay a processing fee to have them re-engineer the paperwork to calculate a new payment for you. And that's been proven to be a very popular and effective strategy for people.
So in the event somebody's worried about rates going up, I mean, they keep their same rate and everything, Mike. It's just
Correct.
That they're able to take that equity, put it into the new home. It all recalculates. Now their payment's lower, and it's just the same mortgage they have. It's just recalculated or as you were saying, recasted, because they've now rolled that equity over, even though they didn't sell their primary home first.
Correct. It's not as simple as just prepaying a mortgage. Not all lenders will have a recast capability. And even those that do, like for our company, we're not supposed to promise or guarantee that a recast can happen. Now, I've never been burned on it in literally 30 years of doing this. I think, there was somewhere down the road at some point, someone tried to recast, and for whatever reasons unknown, the servicer did not allow that. But we know the lenders that have a propensity and a willingness to do a recast. So you have to ask that question in advance and line that up in advance before. You can't just throw the money, wire the money to the lender and say, hey, I want to do a recast. You want to get the stuff all laid out in advance with the servicer at the point at which you're looking to do this recast option.
So back to our original discussion of when should you reach out to someone really early in the process, because if you get too far down the line, and just because you heard on our show today that this is out there, from what you're saying, it's not necessarily out there for everyone, and not everybody allows this to happen. So make sure you actually go into buying your home, but selling your existing home with a plan of action that can happen before just putting it up for sale or buying something else, because heck, that could ruin a deal right there.
Yeah, that would be tough. Yes.
And then, right now it seems like there's a lot of cash offers out there. Again, if somebody's got the equity, tied up in their current house, is there any way to just be competitive with those cash offers that are out there?
Sure. And let me mention too, just about the buying non-contingent thing. The other thing people can do, if they're uncomfortable with starting out with a larger loan amount, if they're uncomfortable with having mortgage insurance, which would occur if someone's putting less than 20% down, what they can do to help themselves, those that have a considerable amount of equity, is to get out in front of things, is to consider getting a home equity line of credit lined up against their home. Now, people will come to me and say, I need a bridge loan, because they've been taught that a bridge loan somehow bridges the equity from the old home to the new home. And I'll say, okay, well, bridge loans aren't as readily available today as they used to be, and they're very costly. Why are they costly? Because a lender realizes that this is a Band-Aid loan that might just be for weeks or, a month or something. And so there's not a big enough of an opportunity for that lender to earn interest on that bridge loan over a period of time. So you get saddled with a considerable amount of fees that you don't see, say, on a home equity line of credit. The person that's interesting that comes to me and says, I want a bridge loan, and I'll say, okay, now let me ask you some questions. Do you have a home equity line against your home? And they say, yes. And I say, for how much? They say, I've got a $200,000 equity line against my home. Do you have a balance? They say, no, it just sits there. Well, guess what? Bingo. That's their bridge loan. That's their pseudo bridge loan. So a bridge loan is a home equity line of credit, no different, but it's called a bridge loan because it's obtained and used at a time in which someone is looking to bridge the equity from the old to the new. Okay. If you, what's very important for listeners is those considering maybe getting a home equity line to line themselves up with this liquidity tool for themselves to be able to draw on, is that they start this many months in advance of listing their home for sale. If I, consumer, look to get a home equity line and I go to bank ABC for a home equity line and I start the application process, if either I tell them when they say, what is the purpose of this equity line? I say, oh, because I'm selling my home. That's not going to fly. They're going to say, okay, I see. This is someone disguising a bridge loan as a home equity, as a home equity loan. And also, if that wasn't disclosed, when they do an appraisal on the property, they look to see if the home is listed. The moment they see that the home is listed, for those seeking a home equity line of credit, the lender says, okay, I see what they're doing here. They're just attaching this equity line as a future resource to be able to draw on for purposes of buying a home. So again, it's really important to get that, if they were to go down that road of a home equity line, to get that many, many, many months in advance of actually listing their home for sale.
Wow, there's some great tips right there. And all of that too, back to our other conversation, in the event somebody's like, oh, well, I've got this IRA or this 401k that they thought that they would maybe have to go to take a lump sum from, which could push them up into another tax bracket, right? Bring tax liability to them that really is unnecessary at that point in times in their lives. You've now just given a couple tips of, hey, here's ways to get you from point A to point B without incurring this other potential tax liability. Great tips. Any other thoughts or tips on I'll say, getting from point A to point B there without
I think that
your initial house first?
Right. I think with really the recast or the home equity line, or for those clients that have a considerable amount of non-qualified, non-retirement assets, to ask whether there's marginability against those assets. Now, margin, is a kind of a dirty word. It's a word that's associated with risk and fear, and you hear all the horror stories about, margin calls and things like that. But used in the right situation, and talking with your advisor, it might be something where, someone might have a balance on a margin loan for a short amount of time until that home is sold, and then those proceeds go to pay down the margin as compared to paying down the mortgage. So that would be another suggested or option that I can think of. Okay. But I do want to touch on the all cash offer thing that you originally asked, and I went off on a tangent here about the equity line. When you think about it, why do sellers like all cash offers? They like it because there's less risk. They don't have to worry about an appraisal under appraising. They don't have to worry about the buyer not getting financing. And in many cases with all cash offers, it can promote a faster sale. They can do with a less than 30-day closing and things like that. So for those, and this has been a big issue for people nationwide with this hot housing market we've seen, is people with all cash offers are coming out of the woodwork. Less now, like you said, than before, just because we've seen a little bit of a cooling in the market. But the question is, okay, if I don't have that tool in my toolkit to be able to do an all cash, and I need financing, what can I do with financing to help mitigate and lower the risk so that a seller sees you, perhaps not exactly a cash buyer, but a buyer in which there's far less risk involved than what they would originally fear? So those things include, as for one, is getting fully approved. 25 years ago, people didn't get pre-approvals. It was a pre-qualification. Well, a lot of those pre-qualifications kind of went south, and people didn't qualify. So they said, hey, we need to tighten this up and make this more official. And so we're going to have different steps and standards that lead to people getting pre-approved. And pre-approved has been something for the last 25 years that's really been the thing that the listing agent, the seller, really the expectations of all parties is that someone's pre-approved. Well, now we're morphing into the next generation, kind of the 3.0. If pre-qual was 1 point, pre-approval was 2.0. The 3.0 now is getting full credit approval, meaning even less risk than that of a pre-approval. The goal with a full commitment, and in our case, our company calls it the power bid approval. And it's interesting, we've got such a presence here in Chicagoland. I've witnessed over the last 5-6 months since we started this power bid approval is people didn't know what it was at first. And then gradually you're seeing the gradual awareness level to what a power bid is. And when someone's working with guaranteed rate, oftentimes the agents will say, hey, did you get power bid approved? So it's just funny to see the gradual adaptation and awareness as to the power bid. In theory, with a power bid, the only conditions that should be left, if properly executed with this approval, is when I go to buy your home, Scott, I make an offer, I can say I'm approved on the loan, not just pre-approved, but I'm approved, and it's subject to appraisal it's subject to title, and it's subject to the purchase agreement. Well, if you think about it, with all purchases, cash or no cash, cash or those with financing, you need title work. So that shouldn't be any different than a cash buyer. So in addition to the getting a credit approved where there's just nominal risks, and the risk being at the end, the purchase agreement, well, with purchase with a financing or cash, either one of them needs a purchase agreement. Both of them need a title commitment. So really the only difference then, if you can just drill it down, is that of the appraisal. So what do we do that's still a risk for the seller? Okay, well, the money talks. And so the question is how much more does your offer need to be than that of the cash deal to where they will take on that risk because they're enamored by the higher offer price? That's one question to have. But also what people can do is take the appraisal risk out of the equation for the seller by saying to them, we will waive our appraisal contingency. In other words, we'll buy the home regardless as to whatever the appraisal value is. Now, to do that, to be able to say that you're willing and capable of doing that, you have to be prepared that if the home does in fact underappraise, that you have more assets to be able to put down, because a lender will lend you based on the purchase price or the appraised value, whichever's lower. Okay, so if on a $100,000 purchase price, if you're putting 20% down, that means you're starting out a loan with $80,000. You're putting $20,000 down. Now, if that appraisal comes in at $90,000, so $10,000 short, now the lender, the most they'll lend you, if you want to be considered to have 20% equity, is 80% of $90,000, which is $72,000. So in the case of a $100,000 home under appraising by 10 grand, okay, from 100 down to 90, is that would involve the client having to come up with an additional $8,000 of cash to demonstrate 20% equity. It's the lower of the two is the basis by which the loan to value is calculated.
Now, if it turns out higher, is that an issue?
No, if it's higher, it's great. It's always going to be the lower of the two. They're going to take the conservative. So purchase price or appraised value, whichever's lower.
Whichever's lower.
Okay.
Gotcha.
Right.
And so it all comes down to, in my eyes, and as you said, taking away risk. And so if you want to be competitive, working with financing to buy a home in maybe a multi-offer type of situation, it's all about working with your team to figure out the best way to take as much risk off the table as you can for the person selling the home.
To make you the most attractive offer, correct?
Yeah, you got it. Because that's what the person selling the home's all worried about. They're like, I'm just selling my home. I want to get the best, what they feel is the best price possible. But they also know, and we talked about this in our interview as well with Lindsay, who is the realtor, is that the seller also wants to pick the offer that's going to get them across the closing table, because if they have to go back out to the market, they might have just lost their sales price. So working with yourself, working with the realtor, just having that best offer possible that takes as much risk off the table. And it sounds like, as you're talking 3.0 here, is like making sure that that's fully understood, that, hey, all it now comes down to is the appraisal. Maybe there's some contingencies that you want to do there. As you brought up the point, make sure that that's well discussed beforehand. You might need some extra cash in your pocket, but sounds like some pretty great ways to be competitive with those cash offers.
And granted, I get it. I see time and time again, it's people are very leery of leaving themselves exposed to be willing to fully, waive the appraisal contingency. So a midpoint where you're not taking as much risk might be something you propose where you say, I'll buy your home. I'm credit approved. Here are the three conditions: purchase agreement, title, and appraisal that are still outstanding. Appraisals, again, the only thing that differentiates itself from that of a cash buyer at that point. And perhaps they might say, I'll buy your home as long as the appraisal comes within, say, $15,000 of the purchase of our purchase price. Okay, so you're not going, you're setting a kind of a floor for yourself, a baseline, to where if it goes under that, then you have the option to get yourself out from underneath the contract. But
Gotcha.
that also has been a very popular tool. Also, is put some sort of a right addendum to the contract that says that if it comes within 15,000, I'll buy it. Any more than that, I have the right to walk away. The reality of it is too, Scott, is that I think by definition, market value in so many words is defined as where buyer is willing to meet seller. Okay, so The buyer originally has agreed to offer a price of X. Okay. An appraisal is an independent opinion of value by one person. And I can guarantee you, if you had a $500,000 purchase price of a home and you took that home, you farmed out to have 5 different appraisals done on that $500,000 home, you would most likely get 5 different appraised values. Okay. The reason why so many appraised values come in at exactly the purchase price is because the appraiser has to have a copy of the purchase agreement in hand when they go to appraise the home, because they have to see what's included and excluded from the deal. What do you think happens when an appraiser sees a purchase price of 500,000? In their mind, their job is to see whether they can substantiate and justify that value through market comparables that they're pulling up in the marketplace. Okay. So again, when it goes back to, hey, you were willing to spend this amount anyway. Okay. Some individual opinion of value has come back with a lower amount, but you have to know what's out there. You have to know what you've bid on previously and what your money gets you. And if you're willing to pay X number of dollars, then I would pay very little attention to the appraised value.
Wow, some great information. I really appreciate that. I think, a lot of us get, just even working with some clients that I've, spoken with, a lot of them get so focused that either their house has to be sold first before they can buy a new house, because I realize it makes us feel uncomfortable. And it does feel uncomfortable, but it's not always the way things have to be done. It's just working and finding the right partners to help us understand the different ways of financing, to look for alternative ways, especially if we want to be competitive in the market. I'd like to kind of pick your brain on some other points as well here. I have clients that are looking to buy vacation homes. Living in Illinois, winters can get a little cold. So they're saying, hey, what if we were to buy this vacation home in Arizona or Florida, or just name somewhere warmer? When it comes to buying a vacation home, so now this will be their it's because I think and correct me if I'm wrong here, but in your industry, you look at this as like primary home versus non-primary home. And so when somebody's looking for this vacation home, are they going to get the same rates as they would for like a primary home? And what factors go into determining whether or not somebody qualifies for a mortgage for a vacation home?
Sure. So up until January 1st of 2022, second home pricing for a mortgage was the same as a primary residence. And I should point out there's really 3 different tiers of pricing. The primary residence, where you're going to that's where you're going to live, that's home base. Second home, that's where I'm going to use, but it's not my primary. My primary is elsewhere. And then there's investment property. That is, I want to rent this place out. I may live there. I may choose to, knock off or set aside 2-3 weeks a year, but the rest of the time, whether it be an Airbnb or a VRBO or whatever it may be, is someone who wants to have that property act as an investment property. Up until January of this year, second home rates and primary homes were the same exact interest rate. Okay, which made things great. After January, that's changed. Right now, a second home is roughly anywhere from 0.5% to 0.75% higher in interest rates than that of a primary residence. So if we're fictitiously at 6% today on a primary home, you might be staring at 6.5 to 6.75. It gets even worse for investment properties. Investment properties prior to January 1st were about 0.5% higher than primary residences. Now they're anywhere from 0.75 to 1% difference in rate. So if I'm talking 6% on a primary, I might be talking 7% on an investment property. Okay. So that poses some challenges and some thinking, some strategy there. I'll tell you the quintessential, when I think of a client that's referred to me by somebody, they might be a 64-year-old couple that has a house here in Illinois. They have little to no mortgage on this house. They want to buy a place in Florida or Arizona or wherever, and they look to get financing. And they want it to be their second home. They still have plans to keep the Illinois property for some time. Well, this now classifies it as no less than a second home. And if their intent is to rent it out, then it's an investment property. So you're seeing a considerable bump in the interest rate, as I described. Okay. So one of the things we do is let's look at the asset here in Illinois, this home that has little to no mortgage on it, and might it be more beneficial to take out financing to leverage debt against the Illinois property, take that leveraged debt in the form of proceeds from the refinance of that property to then go down to Florida and buy that place outright. So you're avoiding the anywhere from 0.5% to 1% difference in the interest rate. You're avoiding that by putting the debt on your primary residence. So, and in the case of Florida, which so often people from Illinois gravitate towards Florida, while all the good things about Florida with no state income tax and some other warm weather and everything else, the reality of it is they make up for it in different ways. One of which is the mortgage tax or the intangible tax or the transfer tax in Florida. So financing in Florida is a whole lot more expensive than financing in most, not all, but most all other places, in the country, and particularly Illinois for that matter, which has some of the least amount of expenses. So there's just, again, going back to that, let's be strategic about how we do this and make sure that, debt is debt. Okay. So psychologically, it's very natural for somebody to say, I've worked all my life, 26 years, I'm 26 years into my 30-year loan. I've got just $30,000 left, or maybe I have no mortgage left. And the thought of going back to having a mortgage makes me sick to my stomach. Well, they just have to, be reminded that debt is debt. Okay. You're either going to pay your debt or you're going to foreclose. They're going to foreclose on you for not paying your debt. So whether it's leveraged against property A or property B, shouldn't the lowest cost alternative be the driving force be behind the decision that you make?
Yeah, I would agree. I mean, when it comes to it, it's looking at the interest, the overall interest that you're going to be paying. If it's something that's important to you to have this second home, that you're going to incur debt to be able to do so, then I would be looking at the overall interest that you're going to be paying out and saying, hey, how do I keep more in my pocket versus giving it to the lender and the banks? No offense, but that's the overall goal, right? And that's what you're sitting here recommending as well, is don't necessarily just jump into getting a mortgage for that second home. Make sure you're looking at all of the options actually available to you, because if you can keep more interest in your pocket, do so.
Right. And then there's some fun stuff I'm sure you've done with your clients where maybe someone's buying an investment property. Instead of taking 1% on 400,000 is, $4,000 a year times the number of years basically that they have that property. Well, one argument could be someone could come to me and say, well, yeah, but with me not having debt on the investment property, I lose part of the expenses that I'll write off against the income, as we all try to show the lowest, net cash flow, net income from the property. Well, there's fun things I'm sure you've done with your clients where you set up an LLC and perhaps, the individual becomes the bank. Maybe they put a mortgage out there where they're lending money to their own LLC at whatever respective interest rate they want to lend it to, therefore continuing to get that interest expense to be able to be offset against the income. So there's just a plethora of strategic and creative options that really are meant to, again, cut down on interest expense and have the most efficient mortgage situation possible.
Right. Great advice. Thanks. And as we talk about, throughout this whole thing, we've talked about assets, cash flow. And one of the things that I've learned from you, and I think, a lot of our listeners are at that age where they are approaching retirement, or they're, about to retire, or they just did retire. And one of the things that I've learned from you is that people really underestimate how it can be a little bit more challenging to get a mortgage in retirement. They, and rightfully so, they feel like, hey, I've got this asset and I've got a lot of equity in this asset being my primary home. Maybe it's $500,000, $1 million, $2 million or more. And then they're looking to sell that and maybe get a new home in retirement, or that second home, and qualifying for that mortgage in retirement in that post-retirement era is a lot more challenging than qualifying for a mortgage in the pre-retirement era, right? Do you mind just kind of explaining that, Mike, and just kind of talking about how people can overcome some of those obstacles? First, why is it an obstacle? I think somebody's right now sitting there going, yeah, if I have $500,000 or, a bunch of equity sitting in my current home, why would it be so difficult to qualify for a mortgage just because I'm retired?
Right. Bar none, this is the single biggest issue, an area that I deal with on a daily basis, monthly basis with clients. The person who works, say, in corporate America, who is used to that six-figure cushy salary, who may have millions in the bank, they retire. Now they want to buy that second home up in Door County. And perhaps they're choosing to not take Social Security just yet. Perhaps they don't have a traditional old school pension that pays them an annuity of income every month. And perhaps they don't want to, rightfully so, perhaps delve into their IRAs just yet. Okay. And they say, well, for the time being, I'm living off of dividend interest income that my advisors, plunking down into my checking account. So this is a big issue. And this is the number one thing people should take away from this aspect of the call is that lenders lend against cash flow and income rather than assets. Okay. It doesn't matter that you have $2 million in assets. What income is being derived from that $2 million? Now, it seems silly, back to that lending sense and common sense does not always meet up with each other. One would think conventional wisdom is I've got $2 million and I'm only looking to borrow $300,000. Why are you putting me through the mill here? Why are you giving me problems? I've got 6 or 7 times the assets to cover that of the mortgage. I get it. We understand it. That is common sense. But lenders always have looked at cash flow, incoming cash flow, as the means to determining and evaluating you as a credit risk rather than at just looking at assets themselves. So with those assets that one does have, there are some ways that we can derive income. In some instances, I like to call it synthetic income, where we're making a calculation based on the assets that they have available. So if you'd like, I'd be happy to go through that, or if you have any other questions first, Scott.
That'd be great. I'd love to walk through an example. I think it mentally helps people actually understand what needs to happen.
Okay, so the biggest thing, our ace in the hole, our eyes light up. If someone is at least 59 and a half years or older, where they're able to tap into an IRA, even though they don't want to, we'll get to that, I promise, because that's an objection people have. It's no, I don't want to do that. I don't want to have the tax implications. We understand that. But when you're at an age, 59 and a half, where you could take distributions from an IRA without penalty, here you'll have your natural tax on that IRA distribution, but without penalty is this option I'm about to describe, it first becomes available. So what we do is we take the value of the IRA. So let's use, if we could, Scott, $500,000 as someone's IRA value. We multiply it by 70%, which is $350,000. And then the lender wants to see that you have 38 months worth of said amount to be able to draw from the 350,000. So when I take 350 and divide by 38 months, that's $9,200 a month rounded. $9,200 a month is no different than someone making $110,000 salary rounded per year. Okay. Now, so we know how much what our guardrails are as far as the maximum they could take based on the 500,000, 9,200. So the question is do they qualify with that, or along with any other potential dividend interest income sources, or not? In the case of the 9,200, now we say at most a borrower will have to take one distribution from their IRA. Now, immediately they say, I told you so. I don't want to do this. I don't want to have the 25% tax. We understand that. Okay. Well, with this, someone maximum one distribution on $9,200. If they didn't pay the money back, then figure just say a 25% tax bracket. They'd be on the hook for roughly $2,100 in tax if they didn't pay it back. But as you know, Scott, there's the 60-day clawback, or whatever the terminology rollover, where I do see clients, or after the fact, they'll tell me that they chose to pay that back to their IRA to make it whole. And as long as it's my understanding, you do it within a 60-day period, it's as if you didn't take it out at all whatsoever. Okay. So the IRA is, I call it a synthetic income, because we're calculating an amount that's derived from the value of the IRA. You might have to take one. And with that, even what lies in question as to whether that's even kept or put back in its place after closing.
And I think with all of this, I'll just throw it out there, but with all of this, it's a working with all of your partners. So if this is a route that you're considering to go down, which is potentially possible, make sure that you're working with your tax consultant, make sure that you're working with your, mortgage banker or mortgage broker, make sure that you're working with your financial advisor. So you've got your team of people that are helping you do this in the most responsible way possible with your funds. And I think it's, really important that you always talk to your tax consultant to get, up-to-date tax advice and that. But I think it, to your point, Mike, this then helps someone get approved for that mortgage, even though they might not have actual income coming in anymore.
That's correct.
Any other things to be aware of from a retirement standpoint? So one is just, it will be a challenge to get approved, but you can do it. And it's just understanding how much is saved up in different accounts, working with a team like yours, with your tax person, with your financial advisor. Any other challenges that you see people run into in that retirement era?
I do. You see people that, in their slow wind down towards retirement, maybe not, they leave, as an example, corporate America. They've chosen to go into the consulting route and do some consulting work on their own. Consultants are generally 1099 employees of their own practice. 1099 employees are considered self-employed. And with self-employed, you need to have a 2-year history of consulting income. So what we hate to see is that person who waited too long to get out in front of this. If someone knows at the end of the year, December 31st is their last day before they retire, and then they're going to start consulting work just after that, and they approach us in July, as an example, that's 6 months of a runway there to determine the things that might be able to be done so that they don't suffer irrevocable consequences, because it's hard to tell somebody, like I said, that has a couple $1,000,000 in the bank that they can't get a $200,000, $300,000, $400,000 mortgage. So those people who become self-employed, 1099 contract work, for us to use contract work, maybe they're going to work back for the same company that they just left when they were previously a W-2 employee. Well, if they don't have a contract for 3 years, a 3-year contract, okay, we can't use that income. If they got a year-to-year contract, it's great that you're making 80% of what you made when you were working full-time, but unfortunately, that's going to delay things for you for generally anywhere from no less than a year and a half to 2.5 years later before we can count on and rely on that income to qualify. They need a track record to see how you're going to do over the long haul and not just how you're doing presently.
And now, if that comes up, do they still have that ability to potentially go down that route of the synthetic income that we were talking about earlier?
If they're 59 and a half, then yes, the IRA, like I say, is that ace in the hole. The problems we run into is the 56-year-old that comes to us, where they can't do social, they're not getting an old school pension, they'd have to take IRAs out with penalty. That doesn't fly. We have to be 59 and a half to use that tool. For those that have a whole lot of assets, there is another thing called asset depletion, in which we can look at the total value of their qualified and non-qualified assets together and divide by a certain number. But it certainly doesn't give you a great deal amount in income. In the case of a $500,000 portfolio, before I said to you that you can calculate about $9,200 in a month in income. When you're using an asset depletion program, $500,000 might get you about $2,100 in income.
Oh, wow,
so it's not nearly as effective. It's less than 25%, probably 20% of what you could get using the IRA tool.
Wow, what a big difference. Yeah. So again, it just all comes down to planning, speaking in advance, having those conversations. Sounds like months in advance. I remember sitting down with you sometimes just saying, okay, what about this avenue? What about that avenue? Because back to what you said up front, having that knowledge up front can save you tons of challenges and headaches that we just talked about.
Yeah, my goal is to offer somebody great clarity and great confidence in what they're doing, that they walk away from that phone call or that meeting and say, okay, I've got a real good understanding of what my options are, the timing of those options, and I know exactly how I'm going to go about this. The industry as a whole doesn't sell advice. They sell price. Well, price doesn't help with these things that we're talking about here today. It's so important that you get an advice-based advisor, people that are willing to pay a financial advisor to work for them. Well, there's alternatives for them too, but they choose not to go down the do-it-yourself method. And for whatever reason, well, I know the reason is why people will generally look at this as a do-it-yourself venture with the mortgages is because it's been sold as a simplistic commoditized product to fulfill a simplistic need. I'm buying a home and I need a mortgage. And that's as baseline simplistic as it gets, when there's can be so much more there to unwrap and to create clarity for for the people, the listeners and the buyers. There's so much more that they can get from a comprehensive understanding as to their picture, total financial picture.
Yeah. And as you say, I mean, when it actually comes down to the real world and how this might be used, it's never simplistic. It's never just as easy as, oh, hey, I decided I want to buy a house tomorrow. I'm just going to go out and do it and click this button on the internet and make it happen. There's always something that could potentially happen within that, or even as we've talked about, a way to maybe make it easier, or a way that maybe that even like you were talking that, hey, there's different ways to look at it that might, save you an interest over the long haul of what you're paying out. So, hey, why not keep more money in your pocket versus paying it out in interest rates there? Mike, just super helpful discussion. Really appreciate it. If people want to find you, follow you, contact you, what's the best way to do that?
I guess phone or email. Do you want me? I can. Phone number is 847-348-1611. And that's my direct line. And my email is my last name, Bischof, just one F. People like to put two, but it's just one. So Bischof at rate, rate.com, Bischof@rate.com.
Great. And we'll link to Mike's phone number, his email, as well as his website. We'll link to all of that in the show notes. Again, lifemoneyshow.com. It's lifemoneyshow.com. You just click on this show, you go to the show notes, and we'll have links to all of Mike's resources there, as well as talked about some of the questions earlier. So Mike, lots of great stuff. Now, it is a show focused on those that are approaching retirement or in retirement. And that brings up that word travel for a lot of people. They've been saving and waiting so long for that. So in your years so far, what is one of your favorite travel spots and why?
I'd probably have to say Colorado. I love skiing. We love the summers. In fact, they say you come out to Colorado to ski and you stay, for the winters and you stay for the summers. So it's got a variety of seasons. It's got aspen pine trees and mountains and 300 days of sunshine and just people are very active. People are very athletic. People are outdoorsy, and it's just a really refreshing kind of environment that we have gravitated to over the last 20 years.
Heck, and it's a place where you can be in a winter coat up in the mountains, and then you drive a little bit and be in shorts, sitting in another city, right?
There are people that will ski and golf in the same day, which is pretty amazing. So
yeah, my uncle is out there. It's beautiful. Every time I come to visit, I totally enjoy it, and have played golf a few times, and the elevation differences. That's pretty fun to play. And I'm sure you're probably used to it when you're out there, but for, somebody in Illinois, it's a lot of fun.
Yeah, it's great. Thank you.
Mike, thanks for sharing, and totally appreciate you joining us today, and have a great day.
Thanks, Scott. I appreciate the opportunity.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.
Michael Bischof Bischof with Guaranteed Rate is not affiliated with Sierens Financial Group, Inc. or AEWM.